Inflation and deflation both change the value of money, but they do it in opposite directions. Inflation means prices generally rise. Deflation means prices generally fall. The confusing part is that falling prices can sound good, yet deflation can be dangerous. Inflation reduces purchasing power. If the same grocery basket costs more this year than last year, each unit of money buys less. People notice it through rent, food, fuel, school fees, insurance, wages, and savings. Deflation increases purchasing power in a narrow sense. If prices fall, money can buy more. But if people expect prices to keep falling, they may delay spending. That delay can hurt businesses, jobs, wages, and investment. Mild inflation is common in growing economies. Businesses raise prices, workers ask for higher wages, and central banks often aim for low positive inflation. The goal is not zero movement, the goal is stable and predictable movement. High inflation creates stress because prices move faster than planning. A salary that worked 6 months ago may no longer cover the same life. Savings lose value, contracts become harder, and people rush to spend before money weakens further. High inflation also changes trust. If prices move too quickly, people stop believing that a posted price, salary, or savings plan will hold its meaning for long. That uncertainty makes ordinary planning feel unstable. Deflation creates a different trap. If a laptop is likely to be cheaper next month, buyers may wait. If many buyers wait, companies sell less. If companies sell less, they may cut wages or jobs. Then households spend even less. This delayed spending problem is one reason broad deflation can feed on itself. Each household waits for a better deal, but businesses experience the waiting as missing revenue. Debt behaves differently under inflation and deflation. Inflation can make fixed debt easier to repay if wages rise, because the debt is paid with money that is worth less. Deflation can make debt heavier because income may fall while the debt amount stays the same. Debt is one reason deflation scares economists. If someone owes a fixed amount but wages fall, the debt becomes harder to carry even if store prices are lower. The number owed stays still while income weakens. Workers experience inflation through real wages. If wages rise 5% but prices rise 8%, the worker is worse off in purchasing power. Nominal income went up, but real income went down. This is why workers care about real wages, not only raises. A bigger paycheck can still feel like a setback when rent, food, transport, and insurance rise faster. Businesses experience inflation through input costs. Rent, materials, shipping, energy, and wages may rise. Some firms can pass costs to customers. Others cannot. That difference decides which businesses survive comfortably and which get squeezed. Deflation can help some buyers in the short run. If technology becomes cheaper because production improves, that can be healthy. Not every falling price is a disaster. The concern is broad, persistent deflation caused by weak demand. A healthy price decline usually comes from productivity. The same product can be made cheaper or better. A dangerous deflation is broader and heavier. It comes from weak demand, fear, and falling income. Central banks worry about both extremes. Too much inflation can damage trust in money. Too much deflation can freeze spending and make debt harder to carry. Policy tries to keep the economy away from both cliffs. Inflation can be caused by demand rising faster than supply. If many people want the same homes, cars, flights, or goods and supply cannot keep up, prices rise. This is demand-pull inflation. Demand-pull inflation can feel like a bidding contest. More money or credit chases limited supply, and sellers discover they can raise prices without losing enough buyers. Inflation can also come from costs. If oil, shipping, rent, or wages rise sharply, businesses may raise prices to survive. This is cost-push inflation, and it can hurt even when demand is not booming. Deflation often appears when demand collapses, credit tightens, or people become afraid to spend. It can also follow asset bubbles, banking stress, or deep recessions. The falling price is a symptom of a weaker spending engine. Weak demand can make businesses cautious. They may delay hiring, cut inventory, reduce investment, or lower wages. Those reactions can deepen the very slowdown that caused prices to fall. For households, the practical question is whether income keeps up. Inflation is painful when wages lag. Deflation is painful when jobs weaken and debt becomes heavier. Price direction alone does not tell the whole story. For households, the headline rate is only a starting point. A family with large rent exposure feels inflation differently from a family with a fixed mortgage. Personal inflation depends on what you actually buy. For savers, inflation erodes cash value over time. Money sitting idle may buy less each year. For borrowers, inflation can help or hurt depending on interest rates, wage growth, and whether the debt rate is fixed or variable. For investors, inflation and deflation change expectations. Inflation may push people toward assets they think will hold value. Deflation may make cash feel attractive, but falling profits and weak demand can hurt businesses. One misunderstanding is thinking inflation means every price rises equally. Some prices rise fast, some slowly, and some fall. The average matters, but real life is felt through the specific things a person buys most. Another misunderstanding is thinking deflation is always a bargain. If falling prices come with falling wages and job losses, the cheaper price may not feel helpful. A discount is less exciting when income is uncertain. Inflation and deflation are not just price movements. They change timing, debt, wages, confidence, and spending behavior. The real question is not only whether prices move up or down, but what that movement does to everyday decisions. The everyday lesson is to watch income, debt, and essential expenses together. A price trend that sounds abstract becomes personal when it meets rent, groceries, loan payments, and job security. Housing shows how uneven inflation can feel. A person may hear that inflation is 6%, but their rent rises 15% while their phone bill stays the same. The official average matters, but households experience inflation through their own spending pattern. Deflation can also change psychology. If everyone expects lower prices tomorrow, waiting becomes rational for each buyer. But if many people wait together, businesses lose sales today. What is sensible for one household can become harmful when repeated across the whole economy. Interest rates connect to both problems. Central banks may raise rates to cool inflation by making borrowing more expensive. They may lower rates to fight weak demand. These tools work with delays, which is why policy can feel late or imperfect. The useful personal lesson is to separate price movement from financial resilience. Emergency savings, fixed versus variable debt, wage growth, and essential expenses matter more than the headline word alone. Inflation and deflation are economic weather. Households still need shelter. The most useful way to compare inflation and deflation is to ask what happens next. Do people spend sooner, delay purchases, borrow less, save more, hire slowly, or demand higher wages? The behavior after the price change is the real story.